think this could be worse than the commercial real estate in 2008?
I do. 7, 8 trillion we have in commercial office right now that if people are being honest and you mark to market, which no one is, it's not pretty. Office structurally is broken until demand is figured out. I think you're going to have some of your largest REITs, I think, are under all kinds of pressure right now. You got Blackstone, those guys throw the keys back. We've thrown the keys back. We try to
Yeah.
work it out. We got lenders, we're battling lenders right now, restructuring across the board. Our investors are worn out, Jack. It's like you took the whole population of the Titanic when they hit the iceberg. There's some guys who knew within 15 minutes who know the ship and the structure goes, yeah, we're doomed. This ain't good. And the other people
Yeah.
are moving, they're playing music. So real estate has that dynamic.
Today's episode is brought to you by MetaMask Portfolio. You'll be hearing more about them later on, but for now, let's get into today's interview. Very happy to welcome to Forward Guidance Anthony Dilweg, founder of Dilweg, a real estate firm investing in commercial real estate in the southeastern region of the United States, particularly offices. Anthony, great to have you here. Can you first start and tell us about your background, which is absolutely fascinating? I believe you used to be a professional football player. So tell us about that wild journey and how did you make the transition from being a quarterback to real estate?
Happy to. And Jack, thanks for having me on. Certainly a follower. Enjoy your show. I grew up in the Washington, D.C. area, got a football scholarship to Duke University. Like a lot of kids, you dream about playing professional sports. If it happens, great. But Duke was a choice because I figure not a bad school to go to, and earning a scholarship was great at the time. Had 3 sisters at the University of Maryland, so I would end up probably there. But eventually played there under a great coach, Steve Spurrier. I like to tell people that some of my business acumen came from him indirectly, so I like to share that at times. And then was fortunate enough to get drafted by the Packers, Green Bay Packers, and then played professionally for about 4 years. And then ended up on a couch in Shreveport, Louisiana in the Canadian Football League my last year. And I pondered quite a bit on that couch going, do I want to continue playing football or had an itch to get into business? Always loved the entrepreneur side. So jumped into real estate in the early 90s.
What drew you to real estate in particular? And is there any, football, like many sports, like almost all sports, it is, physical, but it's also strategic. Is there anything you could apply from football to real estate? Any analogy at all, or no? Is that getting too poetic?
Well, there's quite a bit, frankly. I mean, what drew me to real estate was hit a lot of my press points. I love the deal concept, engaging with people, kind of asymmetrical negotiations, always trying to find ways to create value, tons of inefficiencies in the business. There's a community component to it. Certainly, the team part is important, driving folks to excellence. And then, it's kind of what your spectrum, your risk tolerance is, and depends what part of real estate you want to get into. So in playing professional sports, a lot of those things carry over. I don't know too many athletes that don't, who ultimately do transition into the business world, especially those who create their own enterprise, don't find a lot of correlations and a lot of takeaways. And, if you were fortunate enough to play for some great coaches, like I felt like I did, even in the NFL, Lindy Infante, they're great field generals. So you watch them, you observe them, you ask a lot of questions, kind of like the Socratic approach to my belief system, on questioning folks, also, being thoughtful and being a critical thinker, how you assess things. All that comes together, and it's a pretty powerful experience. And I feel very blessed that I had that opportunity and able to transition into the business world.
So it's the mid to late 90s. You enter the world of real estate. I believe you found Dilweg, your firm, now in 1999. That world of the late 90s, I'm not a real estate guy. I know that housing had been going up and there was going to be a huge housing bubble in the early 2000s. But in the world of commercial real estate, I imagine they're somewhat correlated, but not the same as single family housing. So what did you start investing in? What drew you to that? Was it apartment buildings, offices? Now I believe you're mostly offices. We'll talk about that. But what drew you to that asset class? And what was that environment like? That late 90s and then to the early 2000s?
So, early 90s when I got in as a broker, as a tenant rep, and I got into some investment sales. I figured it was a good way to learn from some of the top landlords in the area or the region, some institutional landlords. It took me a while to earn in there because I was young in the field. Also, the S&L crisis coming out of the late 80s, that was intriguing. I think the first book I believe I read was The Daisy Chain, which is all about the good old days when they used to leverage up 110%, 120% guys to get their fees out. So I heard all these stories. I thought that was intriguing, but I really wanted to learn from the ground up. So I bought a number of rental properties. I don't recommend this for someone starting off, but I remember, a lot of my NFL money was tied up at the coast. I invested in a place called Q Island and some of the coastal areas. Not a lot, but I remember signing up for like 12, no, I'm sorry, like 22 credit cards that you could advance those dollars. I used as one of my first down payments on some duplexes. So super trying to be clever, trying to be creative, but also recognize the element of hard work. So when I got into it, I'm like, it's an interesting time. The housing market was decently solid. The office market was recovering. I thought it was a great time to be curious and ask a lot of questions and continue to learn with the intent to eventually get into the investment side, less of the brokerage side and the third party business. I always felt like wealth creation would be around there, obviously on the investment side, but also, there's a tremendous amount of risk there too, as you recognize, Jack. So all those things, I was young and, probably reckless and didn't, I was kind of ready, fire, aim. So the acceleration was fast and had a bunch of failures early on and learned from some really good people.
In investing and macroeconomics, there are a lot of gurus who can say, "Oh, I know exactly where the 10 year is going to be." In your world in real estate, a lot of gurus too who say, sign up for my course or get invested in leverage. So the actually successful people such as you do not recommend getting into it and doing what you do because it is so risky. You're maybe a little bit less risky than football, but yeah, 22 credit cards, that is risky. So it's mostly apartment buildings, what now is called like multifamily, rentals.
It was single family and duplexes,
Okay.
and then ultimately transitioned into, it was probably, we were more agnostic when I started my company. So we did jump into, it was very opportunistic. I had, and it was, self storage, some multifamily, these are 150, 200 unit, complexes. Self storage, we grew to about 1 million square feet, sold part of it to Red McCombs out of Texas. So that was a hot, that was a hot, not a hot product at the time. It's become very hot in the last 12 or 15 years. Since I had my roots in office, we did some office and then some flex. So, we were small. We were boutique, mostly North Carolina, and then doubled down and transitioned out of the great financial crisis into office. So I
Mhm.
picked the winner. It's been fascinating what we've experienced the last 3 or 4 years. Certainly, I know we'll get into it of where that's going and remote working and how it correlates to other real estate. But anyway, I'm super intrigued to where it's going to head.
Yeah, me too. We'll get into it in a second, but just so you founded Dilweg, investing in self storage, single family, multifamily rental apartment buildings, and then office. How do those asset classes differ? Are some riskier than others? Are the leases different? And the valuations we could talk about. Cap rates. Like, how are those asset classes different? How were they different then, and how are they different now?
So I would say then, which this particular sector hasn't changed a whole lot. The self storage sector, which is unique about the barriers of entry are very low, but the great thing when you turned over, you broom swept the units, right? So it wasn't not a lot of maintenance, pretty straightforward. But like I said, a lot of people get into it. It's very mom and popish, and that hasn't changed. I know it's been more institutionalized. It's gotten more institutional traction and money in it today, and it's done extremely well. Multifamily were value adds. We went in what a lot of folks did here in the last 2, 3 years, which I think it's with rates screaming high is going to hurt a lot of these multifamily guys who bought these kind of B and C products and reposition them. I think they're majority of them upside down right now, but we did that back in the 90s and did well. It's good timing for it. Wasn't a supply issue in the markets we were in. Office was the most capital intensive. I always use that as I felt an advantage if you're super selective and pretty shrewd on how to spend the money. Back then, leases were done. We had a 5-year office lease. You'd offer a tenant a dollar per square foot year for improvements, and then you'd lean on the tenant to with the money to the table. When they said no, then you'd amortize, maybe another 10 or 15, $20 on top of it. And that's where you get a nice uplift in the rent. And when you cap it out and sell it, you got a premium as long as the governor was the per square foot number. So that worked really well for us. That world has changed materially now. Tenants want $60, $70. And it really doesn't make sense that, well, office is broken right now, but the other, industrial, we didn't do much industrial, did some retail, open air retail centers, grocery anchored, and those were classic value add. We would work, Jack, we would work the tenant base really hard. We were very active. What I learned is from starting off is I felt like when I represent a lot of the institutional guys, I mean, they were smart, they're bright. I wouldn't call them the savviest group. And I felt they were babysitting a lot. Like we would go and be aggressive to tenants early and say, listen, this is a 3-year-old lease. You got a termination or a 5-year lease. You have an early termination. It was done 4 years ago. Maybe can we get that kicked out because it helped us with our value? What if we gave you $100,000 in improvements? We'd try to restructure a whole rent roll. It was a lot of work, but there was a lot upside in that. But it was just rolling up your sleeves, being thoughtful, being creative, know how to negotiate, and being assertive and aggressive there. And I felt a lot of people just wait to the tenant to roll before they hit it. Our philosophy was very different. It wasn't easy to do because it's just a lot of work and a lot of moving parts. And you're working with a lot of people that it was hard to get their attention at time, but we've had a lot of success with it.
So you said office is the most capital intensive. You don't mean in terms of acquiring the property, you mean in terms of maintaining the property, right? And improving
yes,
it. You say value add, you mean you're adding stuff to it.
Yes, unless you have a pretty strong repositioning, on the acquisition side, cost.
Right. Okay, so office, it was the asset class that had people asking for things the most. Is that tenants complain more in office because it's a workplace than in their apartment buildings? Is that what that means or no?
Well, depends on the kind of office. Depends on the first of all apartment complex you run. If you're a B and a C office, apartment developer, you're probably getting a lot of complaints, and you're trying to stay ahead, and your tenant base is different. Office, it's a different mindset, right? Because I felt like when we were multifamily, it was more emotional. Office is more, it's just more sterile, more calculating, more measured. People, it's you got kind of a commercial mindset, except when you have the residential, just people seem to get more emotional. So I like the office side because I felt that was I was built for that. I didn't like the emotional side I didn't think you got paid enough for the emotion on multifamily. If it got emotional in office, it's not necessarily bad. Usually it, from our experience, leads to, if you know how to navigate it well, it can lead to some great upside if you know how to negotiate well.
Yeah, I get what you mean. Okay, so at what point did you realize office is where I want to really specialize?
Well, since I got my roots in it, and certainly was intrigued with the business community, the Fortune 500 companies. Tech was expanding, or has been expanding, obviously, over the years. Finance, fintech. It's just intriguing to get to know the tenants, know their business plan, or get a glimpse into the business plan, get a glimpse in their P&L. Talk to the CEOs, so you learn a lot about the business community. And I found that a lot more intriguing than dealing with residential tenants, and then also shopping centers. Although retail is intriguing, I'm sure pretty interesting to a lot of folks, but I just found the business side just kind of where it was going. And, it's been the core for this country for a number of years. So it was just an area and I thought we were well tooled. We had a lot of talent there, and it just felt like a good position to a good foundational position for the company to steer toward.
Right. And I guess now is a good time to talk about interest rates. And we're still in the early 2000s. So, in the finance professors, when they talk about the stock market, they say, oh, if interest rates are at 0 and the 10 years at 1% or 2%, equities, that earn 5% on their return, that's a 3%, risk premium. But if interest rates go to 5%, then the risk premium should, adjust higher, and so stocks should be worth less. And in theory, that works. But interest rates have gone up a ton this year, and the stock market has gone up a ton. In real estate, is it a little bit more mathematical, where if your leverage and interest rates go up, the cap rate should go up accordingly. In other words, like in 2003, when you had a huge collapse in interest rates when the Federal Reserve cut rates after the dot-com recession, which in retrospect was quite mild. I mean, was that kind of a boom to real estate developers such as yourself, as well as homeowners?
It's one of the probably significant material debates in our industry over the last, I don't know, 50 years. Does it correlate cap rates with interest rates? Peter Lindemann is a guy that, is well regarded in our industry as an economist. He's been at Wharton. He's that said that, you got to really care for these statements, right? Because they're all nuanced, right? So he said, well, they really don't correlate. I don't know. I mean, I've been doing this for quite a bit, and with the violent upturn that we just experienced or we're experienced in interest rates, it's impacted this sector pretty, our area pretty significantly. Plus the 10-year now, when it went to 5 and now it's back to what, 4.4, 4.5. That's a measurement. It looks like it's going to be sticky there. That's been a jolt to the system. It's like real estate. Problem with real estate, guys, it's like it's such a slow moving business, and your behavior change is such a part of it. And the challenge is your mind may be way ahead of really what the market's doing. I find that as a big challenge in our world. So it's a big lagger. It's not a great forward indicator. And I think these, the interest rates absolutely do impact real estate even more. This is unprecedented in my opinion. Now I've only been doing this 30 years. Obviously, you study history, and I've listened to some of your podcasts about the debate on recession. Are we in a recession or not? I'm tired of the conversation. I'm a slice guy. There's different sectors doing great, other places are depression, some are recession. It's very complicated today. I think we like to
Yes.
throw things in bundles. And are the interest rates going to lag? Are we going to somehow get out of this? MMT going to kick back? I don't. Powell seems like he's going to hold on longer here. Actually, I think it's probably in some ways really good. Stuff's going to break here. I'm seeing it. I'm on the front line, so I'm seeing a lot of things. We're anticipating a lot of issues here that haven't materialized left. And we're at 20. Office is a $20 trillion sector in the US, roughly, if you took 5 billion square feet. And people are talking about rates. I mean, they're talking about, maturity of loans the next, 1.5 trillion in, I don't know, 18, 24, 15, 18 months. That's not my concern. It's the 8 trillion we have in commercial office right now that if people are being honest and you mark to market, which no one is, it's not pretty. It's really ugly. Not saying you can't get through it and navigate. There's all kinds of tricks and avenues, and we've gotten really good and creative at doing that. But interest rates, it's been a huge blow.
A huge blow. Let's talk about that. I should say. So right now you have $2 billion in assets under management and 5.5 square footage under management at Dilweg. In the stock market, everything's trading and the stock goes up 10% in one day. Are the future cash flows 10% higher? Obviously people who are trading every day, they take it way too far on one side of the spectrum. On the other side of the spectrum, people who invest in asset classes that do not trade for many, many years, it's hard to see where the value is at all. Is that fair to say? I think you were saying in real estate, if you acquired some building in 2018 and your cash flow, your net operating income of I guess the rent minus the expenses, you're dividing that by the price of the property to get your cap rate. Are you using the price of the property, or are people in real estate using the price of property from 2018? Are they getting an auditor to say what is it valued in 2021? What if those values differ from 2018 to 2021 or from 2021 to 2023?
So let's anchor on forecasting, because that's what our sector likes to do a lot. And structurally, the challenge I think we're having right now, and we'll just focus on office. I think some other sectors certainly are having some of their own issues. Multifamily, I think it's going to be worse than people expect, in my opinion, but could be wrong. Certainly, it depends where and the product type. So we forecast out and we look at variables. We look at, okay, what's the retention of tenants going forward? Maybe we typically use 65, 70%. And now we're debating whether it's 50% or 25%. That's a material move. And are the future tenants going to contract or not contract? This is on top of studying your rent roll. Okay, what sector is every tenant in? Look at your rent roll. We got 1,000 tenants. What sector are they in? What's the credit? What's the forecast? What's the leadership? What's the culture like? You're looking at all that. You're scrutinizing, and then you got them on this you got them on a forward assumption channel where you got maybe 25 tenants in a building, and they're either rolling next year or in 6 months or 5 years from now, and you're running an analysis against the retention on that, and then what's the cost to retain? So is that component to it? And then
Cost to retain, what does that mean, cost to retain?
so when renew a tenant, for example, does it cost $15 in TI allowance to retain them or $30? Do we have to give them 6 months free rent or 12 months free rent? Do we have to lower the rent? So there's a front end transaction cost. So on a 10,000 square foot lease, it costs you $250,000 to pay the broker and to give the tenant some tenant improvements. So that's the front end transaction cost. And then, Jack, you don't really get paid back on this stuff, for a while. Like you look at you run these analyses, like, wait a sec, it's a 5-year deal and we're putting up these dollars, good credit, but we don't get a return. The money we outlaid and the cost of that money may be 2 years, 2.5 years before we get paid back. And people, the way to bail out of it is you'd find ways to increase your face rate. So the next buyer will buy that income stream, the higher rental rate. Now they're going to do their studies and they're going to understand the market conditions. You got to stay within a band, and they're going to find a way to go say, can we make money with all the capital investments going forward? Ultimately, when we exit. So we run these on retaining tenants, recruiting tenants, and then certainly the stuff you mentioned earlier about the cost to a functional and cosmetic costs of the building, which are pretty significant at times. So you add all that up, and then you put a future cap rate on it. And right now, office, was trading in the 5.5s to 7.5, and we're seeing deals in the 10 to 15 cap range. So it's all upside down. So all these, and plus, because it's so broken, what's the future of office? The debate is if the internet to shopping malls, is like remote to office now. Well, we had supposedly about 2,400 malls in this country. Now it's down to 700, but that was over 20 years. This is really quick. It's hitting hard. So it's a big sector. It's not the mall sector, and it's in the heart of cities right now. You got New York, you got San Francisco, you got Portland, you got Seattle, you got Austin having problems. These cities have their hands full, not to mention the suburban stuff. So all that stuff adds up. It's pretty fascinating.
Yeah, and so I think none of your buildings are in those major Northeast or California cities. So you're not quite in the eye of the storm, but you're definitely I don't know, maybe I mean, are you seeing it in the Southeast?
We are.
Okay.
We're in downtown Atlanta. We're in Dallas, Charlotte, smaller secondaries. Charlotte's uptown area is going to take years to recover. I mean, the office B property is probably going to 50% vacancy if you actually count in sublet space, which shadow space is a whole different debate and discussion. Mm-hmm. Groups contracting. People want something cool, funky, urban, experiential, and there's this collision between hospitality and office debate, which we're on that board. You got to reimagine the space. So, these traditional, office goes here, retail goes here, multifamily. I know we've worked over the last 20 years to kind of disrupt that, but I think it's really getting disrupted now. And these cities in the Southeast are getting hit by it. Miami's not. Miami's got their own dynamics doing well. But that's in the suburban office. We see that, and there's stuff in the suburban side that I'd say it's a race to the bottom that ultimately they're going to get scraped and be repurposed or property rezoned. We're selling a property to D.R. Horton housing industry. You get speakers. Are we 3 million under housed, 8 million? I don't. Sometimes we'll see. I like to look at research. I look at a lot of research, and I'm always skeptical. But we've got an office building under contract in Atlanta it's 100,000 square feet, and they're going to scrape it and put 80 townhouses on it. And I think that we're seeing more of that in our space, and great, a really ideal premium locations.
So you sold a building to developers who are going to scrape and turn it from an office building to an apartment building.
Correct.
Yeah.
Correct.
Okay.
And that trend's. I mean, Jack, you got 5 billion square feet roughly. This is CoStar data and CBRE. That CoStar is a primary data source for our industry, public company. And then you got CBRE, these real estate companies, JLL, get about 5 billion square feet. The debate is you've had roughly about 400 to 500 million square feet as a float, as vacancy. So the debate now is, my base case, we're going to have 1 billion to 1.5 billion square feet on top of that float that's obsolete in the next 3 to 5 years. Those are the debates that are going around. That's frankly kind of my base case. Upside, I'm not sure what that looks like right now. Downside. So we think there's tremendous opportunities to go in and repurpose office buildings. You hear a lot about the multifamily. I think that's going to be a lot smaller than people are hoping. It's a lot of work. You got to get the building down to $25 a square foot. It's very low. Guys are expert. We're studying that space pretty hard, but this stuff is what's coming. And I think all these people are white knuckling it, trying to put money in deal, trying to hold on. I'm not saying things could pivot, but I just don't see it. I think interest rates are going to remain higher for what I know
Hmm.
that's being discussed. That's a big jolt. And office structurally is broken until demand gets figured out. you know, I think you're going to have some of your largest REITs, I think, are under all kinds of pressure right now. You got Blackstone; those guys throw the keys back. We've thrown the keys back. We try to
Yep.
work it out. We got lenders. We're battling lenders right now, restructuring across the board. Our investors are worn out, Jack, worn out because they've been putting money in. We've got endowments. We got family offices. Had some private equity relationship, but so for a guy like me who's opportunistic value add, if I can survive, get to the other side of this, because we're getting beat up pretty good, I think it's going to be an extraordinary chance to create wealth in the real estate space.
Yeah, you know that you're getting beat up and you're realistic about it. I feel like the people, who are saying, "Oh, actually, things are fine." And we're going back to this 2019 world where everyone's going to the office 7 days a week. If you're a little unrealistic, those are the people who might get carried out. But you're realistic, which is good.
Yeah, and certainly, Jack, you make an interesting point, right? Because these guys have, it's if they can play it out and get enough leadway at the lender, it's one thing. In great financial crisis, we bought a bunch of debt back at a discount. We tried to negotiate with lenders. They actually capitulated. We actually felt we had enough visibility to buy back at a discount. This is what we did, and we felt good about the fundamentals. I just think certainly for office right now, you can't have somebody being honest and frank on any conversation today and say they have a clear picture where they think it's going to go. Now, there are markers like Related Group, Hudson Yard out of New York. Those guys are, I think, doubling down on newer product. There is a flight to quality. I don't
Mhm.
disagree with that. And we have a creative single story office, dropping in a brewery, doing riding birds around, putting climbing walls up. I think that's good. That's helpful. But at the end of the day, my stronger belief system is companies have to get their culture right to get people back in the office. You got to create FOMO. You can do all these cool kind of tricked out amenities, but if you don't get your culture right and people don't feel like they're missing out, and we're a culture, we want to be together, but you better have a compelling reason because right now technology is kicking its ass. It's doing a damn good job right now. So that's the friction and the tension I see.
Yes, but at the same time, Zoom, where people are doing all this remote stuff, they told their employees that they have to go back to work. So there's two sides to every story.
Yeah, but Jack, but let me tell you something. For every CEO that is telling you that says that, and let's say for every 100 CEOs that are telling you that, I'm talking to those CEOs of those 100, I may be talking to a small portion of them. It's very squishy. Their
Yeah.
policy about people going back to the office. In fact, if you look at Castle data, Castle
Mhm.
systems, they monitor card swipes in buildings, and their methodology is wonky because what they do is they swipe it once and they count you in, and that's flatlined. They got 2,600 properties in the U.S. and 47 states, and they hit you as like one card swipe. Jack, you go in the building and you count in for the day, okay? And it went from they did it right to COVID. They said 100%. They used 100%, which is probably you and I would understand that Fridays were probably half day before COVID anyway,
Mhm.
and that plummeted to 15% utilization rate. So people actually go in the office, but it's just a swipe. Doesn't say how long you're there. It went up from 15% in the first 18 months to 40%. Then over the next 12 months, it went to 50%, and it's flatlined for the last year now.
Are you talking
And
about
we're
Fridays
using
or every
pace.
day? Every day.
Pardon me?
Are you talking about Fridays or every day of the week?
No, every day of the week,
Okay.
cumulative. So I'm making. I think first of all, those are nicer buildings. Second of all, I think that's overstated, 50%. And I'm talking to these guys about people going back to I think they're trying. We need, listen, there's the component that I'm not a doomsayer to say that where no one's going back to the office. I think it's hybrid, maybe 2 or 3 or 4 days a week, or maybe half. But and I don't really like the cat. We're shifting to Pacer AI, which is going to monitor more cell phone use, so we can see exactly who's in the office, not who. We know by cell phone data for how long, so we can market, and you can distinguish between visitors and tenants. So there's a lot of work to be done here. you got to be careful about what statements you make, but I don't know. I'm living it every day. You got to be careful when you're in the trenches because sometimes it gets so dark. So you got to get some elevation to get some perspective. So we try to balance that out.
But yeah, you don't want to get out of the trench for too long because the trench
No,
protects
no,
you. You
no,
know.
no, no, no.
So you said utilization rate. Is that similar or the same thing as occupancy rates, which I've also seen Soul data report?
So it's an important question. So utilization rate would be okay. A tenant has 40 full-time employees, and 10 of those employees are in for the day, for the entire day. I'm going to say an 8-hour day. That'd be utilization rate of 25%,
Mhm,
but a occupancy of 100%. I mean, they occupy the space.
mhm.
So this is where it gets very careful the way people throw words around and stuff like that. So you got to really look at, like, I just go back to when people say, "Oh yeah, these guys they're back in the office." I just talked to one of our larger lenders, and their policies get everybody back in the office. I said, "Okay, what does that really mean?" They said, "Well, they say 5 days a week, but they don't really monitor us. But we have to just make sure we checking in on Tuesday, Wednesday, and Thursday." Like, all right, I'm talking every time I have a chance to talk to somebody, I get a little insight. I haven't heard anybody, I haven't met anybody back yet after talking to that Monday to Friday full time, which I wouldn't suspect, but it's going to land somewhere in the middle.
Really, no companies? There must be companies that are Monday to Friday, like a law firm, an investment business. There must be companies. I mean, that's what
I
you
have,
hear, right?
well, so we're clear. My sample size is not huge, but I'd love for someone that has every one of their employees showed up at 8 or 9 in the morning on a Monday and go till Friday at 5. I'm like, I don't buy it. But
Yeah.
that wasn't going on. Friday was I think we got to have an intellectual, honest conversation about where we think it. Talk to people, ask. Got to get to data. There's a lot of conversation, and if it's 2 to 3 times a week, which would Tuesday through Wednesday, it is what it is. That's why we launched a business small fund on SDRs and Airbnb. We're in small towns in North Carolina right now, like Blowing Rock, North Carolina, Elkin, converting old commercial buildings to Airbnb. And on Friday and Monday, we're offering to our tenants to say, "Hey, listen, take your family to the mountains. Enjoy it. It's set up internet. You can do business on Monday and Friday." And I think your Monday and Fridays are going to just create a longer weekend. That's why I think hospitality is interesting. How that's going to play out. And people want the experiential side's a part of it too. But yeah, a lot of moving parts in there.
Okay, so occupancy just looks at are people in the building. Utilization is maybe a little bit more holistic, looking at how long are they actually for. So, but the occupancy data that I'd seen showed, yeah, maybe Castle it flatlining at 50%. But that doesn't mean, and to someone who's not in the business, I had to learn this. Occupancy is different than vacancy. Vacancy is what, from a financial perspective, matters. Are the landlords being paid? Are there tenants in the building? Occupancy are the employees and then the people actually using the product and going into the building. So for example, in the summer of 2020, when you could walk down New York and see all offices, none of them had any lights on, you could get a little worried about, are the landlords being paid? But actually at the time I didn't know this, but they were because the leases for those are very long. So earlier, maybe 10 minutes 20 minutes ago, you said you think vacancy will go to 50%. And if you said occupancy at 50%, that's already true. But you said vacancy, so you mean that literally half of the offices, not only people are not in the building, but they won't have tenants. I mean, that's it's pretty drastic.
Yeah, so it's a really important point, and you're hitting some really areas that makes this thing nuanced. Back to like utilization, occupancy. There's what they call shadow space, which is like sublet space that the tenant likely is not going to renew, and they're trying to sublet. So we don't like to compete with sublet space because that makes it more difficult. And then you have credit issues if people are delinquent, not paying the rent. So you're kind of looking at, okay, what's the total occupancy? Eligible paying tenants. So you could be at 93% on that if everybody paid, and it's not relevant to who's in the building, who's not in the building, but you have contract leases. And then it kind of goes, then you're kind of looking, are we in a market that you think that's going to improve and there's stickiness to it, or is deteriorating? That all is deteriorating. So when you see stats, when people go, "Oh, there's 13% vacancy, the most it's been," when I say 50%, and just so I'm clear, I wasn't talking about Alyssa. I was talking about Uptown Charlotte in the context of Class B, shadow space and direct vacancy. The shadow space is the one that's kind of elevated things, and I think it's heading that direction. We have submarkets. Like I have CoStar data I'm pulling in some markets in the Southeast, they do what they call availability space, which is basically sublet indirect. And you like to know the difference between the two, because if your direct is 8%, but your sublet space is, makes up 20% of that, so you're at 28% total, you're going to study the sublet space pretty hard, because some people are just testing the market. They may come back and take the space back in. You got to study those tenants. Some of these things I've seen in the markets are, between 30 and 35%. In my world, as an investor, I read the headlines. I'm like, listen, the headlines are always tricky. The press is tricky. You're gonna
Yeah.
frame it up. You're gonna interpret the way you want to interpret it. So you got to ask a lot of qualifying questions, which I love about your podcast. Jack, you do a great job of probing and asking questions. You're so curious. It's really good. So that's when you get to the meat of it. You can see what's going on. I'm just seeing this train wreck being created by structurally the demand components. And I got data there. Like VTS is a software we use to track every tenant activity in our portfolio and new inbound traffic, whether it's inquiries, prospects, tours, LOIs, proposals, doing leases. Their demand metrics, where they track a lot of buildings in the US, the demand is now hovering around 50%. In some cities, it's like, I think Portland's like 21%. So all the demand that we saw pre-COVID has dropped materially. Plus, people aren't retained. They're not sticking around as long, and they're shrinking. You add all that up, it's a lot worse than the headline. So I see that. So I'm like, oh,
Really?
what's the lag effect? And we're slow, and you put interest rates, and it's a $20 trillion industry. If you're not marking to market, I don't know, 24 and 25, and lenders, listen, if you're being honest, if you marked, 2/3 of the U.S. banks, and if you look at the U.S. banks, mark their market with all the treasuries they got,
Yep.
from 2
Yep.
years ago, you mark that, you mark real estate, everything else, they're insolvent. I know there's ways around and workarounds and stuff like that, but no one's got to sell something. You're not going to take the hit.
Absolutely. But first of all, by the way, thank you so much for saying those kind words. I had done a few episodes in commercial real estate. I'd say a fair number of them were somewhat bearish. So I was looking forward to this. Oh, I'm actually going to talk to someone on the ground, and he's going to say, Jack, the headlines are super negative, but they're actually, they're cherry picking bad data. Actually, the fundamentals are a lot better. Because you talk to institutional investors, they tend to be a little bit more rosy. But you're saying actually no, the headlines are not bad enough. It's actually much worse than the headlines.
Correct. Yes. Yes. And listen, you asked also, so, we like to say, are people, I like to, you're an optimist or a pessimist, and then you're going to read the market that way. So, and I know there's some adjustments and recalibration on some of those conversations. I mean, I would say I'm an offensive guy, played quarterback. I see, I'm a bullish guy. I see opportunity. I recognize the value of a great defense. I recognize, asymmetrical warfare. You got to know when to brawl, and, you're forecasting a lot. And at least in our space, I think the guys who got ahead early, well, early doesn't really mean anything. It's going to take some time to play out. What's intriguing to me, which gets me very excited, is what I believe the opportunity is going to be on the other side of this. Because with this material dislocation, distortion, destruction, and listen, it didn't help. When the Fed pumps 9 trillion into the system, and you get MMT, all this stuff going in, and look at household net worth. In 2000 it was 42 trillion. Now it's 154 trillion. There's a lot of wealth in this country. When you have that kind of money sloshing around the system, it distorts things. It's distorted our industry. So to get some of that out of the system with Palestine, I'm actually like, we got to get things corrected here, and we don't we don't have a strong appetite for that. We like to bail ourselves out, and that's a problem. It's made my life more difficult as an operator.
Today's interview is brought to you by MetaMask Portfolio, your one-stop shop to manage your crypto assets and access a range of Web3 services all in one place. Overseeing your crypto assets across different wallets and networks can be very complicated. MetaMask Portfolio solves this by giving you the reins to manage your crypto from a single decentralized application, or DApp. Just connect to MetaMask Portfolio to get a bird's eye view of all your coins, tokens, and NFTs, and you can easily buy, sell, swap, bridge, and stake crypto assets at competitive rates right within the app from a vetted list of providers. No more jumping between dozens of sites and apps. MetaMask Portfolio lets you do more in Web3 your way, giving you secure and convenient access to a wide range of features and services all in one place. Manage your portfolio your way with MetaMask Portfolio. Click the link in the description of today's episode to get started. Thanks, let's get back to the interview. You talked about earlier the banks having issues with mark to markets, treasury security or a mortgage backed security, you just put it into a calculator. Oh, this was $100, and now with interest rates here much higher, it's worth $82. And in mark to market, that's pretty simple. But with real estate, it's in the eye of the beholder. So it's tough. Is this building that was valued at $500 million, is this building still worth $500 million? I mean, I don't know. I can't put that into my calculator. My calculator is saying I don't. So it's tough. And earlier when you're saying the office space, it was in the 5 to 7.5% cap rate, which is valuation metric. So maybe you can compare that to like an earnings yield in the stock market, but although it's not really the same thing at all. But you said now it's in the 10 to 15%. So I just want to explain for the audience, that's not because the rents have gone up so much. That's because the denominator, the actual value, has gone down, right?
Yes.
Yep.
Yeah. Yes. A lot of these buildings are trading have relatively higher vacancies, maybe in the 15-20%. They have, WALT, which is weighted average lease term. That's a big term that's, people look at what's your average, look at your leases, when's your roll exposure. And it's so murky on knowing how you see demand for office that do you put, you're absorbing 10,000 square feet next year, or you putting zero for the next 2 years, or 100,000, or you losing tenants. So all those are playing into it. So all these forecasts, we use a software called Argus, and that's our industry standard for lease office. And you've got tons of variables in there, and it's so interesting to see the debates with lenders and investors on what people believe is going to happen. I'm just saying the guys on the front line. I'm not going to even use pessimistic. I think your comment's a good one about being realistic.
Mhm.
It's just when do you start feeling that pain? And there's this. It's just so slow. It's like the first 10 minutes. You took the whole population of the Titanic when they hit the iceberg. There's some guys who knew within 15 minutes who know the ship and the structure goes, yeah, we're doomed. This ain't good. And the other people
Yeah.
are moving. They're playing music. So real estate has that dynamic. And you mentioned comment. It's like there's so much the transparency, the mystery behind it. It's a huge asset class. That's what makes it very intriguing. That's what I found interesting to it. But now there's been more transparency, but still, people are, they got to make, there's really a lot of tough decisions. And, we're talking to national banks, regional banks, and community banks. They're all behaving differently. We got 3 debt funds out in New York. They're behaving differently. It's amazing. They got their book. We got our book, but
Sorry, so all the banks who are lending to you to finance your projects, and then the 3 debt funds, they're also lenders. So bank lenders and non-bank lenders, you're talking to them.
correct. That's right. And how they're behaving. And, we've had some of the national banks, we've gone to them and said, listen, we think this is going to be rough. Let's see, let's lower the rate to 5%, go from 9 to 5, and maybe we cruise some. If the property cash flows there, let's roll the money back in, and let's be super selective on the next tenant we land, retaining tenants, spending money on the property through function or capex. Let's play. If you want to ride it out, because right now I'm getting BOVs, broker opinion of values, the brokerage community. They're all over the place. I got 3 lenders. We're taking properties to market, and we got one in Tampa that was probably worth about 40 million, 170,000 square feet in Tampa. The loan amount is 21. It's with a debt fund. We got offers at 11 million. The buyer that did it, we went under contract, fell out after 2 weeks. They got scared. I mean, it's a bunch of cowboys buying the building, and they're willing to take the hit. Maybe a good move, because that property may be worth half in 2 years. Suburban is tough, Jack. It's really tough right now because it doesn't have the amenities, doesn't have the high walk scores, it doesn't have the cool, funky look to it. And people are like, it's just boring. I need something cool and unique, and something that's provocative, and an ethos that really is compelling to attract tenants back to the office. So that's a challenge in itself.
I want to talk about, duration. You talked about WALTs, weighted average lease term. I think that's really important. So, in the bond world, you can invest in a bond for 1 day and you get very short-term interest rate, or you can buy a bond for 30 years, or, an Austrian 100-year bond. And if you lock in a long-term rate at a low rate, that's bad, and then interest rates go up. If you lock it up at a high rate, interest rates go down. That's really good. I think maybe a similar analogy can be in the real estate world, where in this bull market of real estate, pretty much a lot of your career, was it a good thing to have short-term leases, because then you can always roll it up? I got a new tenant up, I'm increasing the rent. and I have a 30-year lease. That kind of is not great because I'm missing out on this huge, 3-decade bull run in real estate. But now, is it the opposite where you would want to have a long-term lease? You'd want to have a 100-year lease locked in at 2019 rent levels because rents are coming down. Also, are rents coming down? It's tough to see. Looking at the real estate investment trusts, they're not going down. Some are. It's tough to say, but are rents going down? I mean, they're definitely, the rate of increase has definitely gone down, right?
Few things. One is historically that the office sector is really anchored on long-term leases, 10, 15, 20-year leases. During Depends if you feel like you have some leverage where you do shorter term leases, less transaction costs because you can capture the upside. That's a rare phenomenon. I've seen some of that because it's been in demand. Tenants want a little more flexibility there. But I also, I think that part of the challenge is you got all those moving parts on the lease term. And then what was your second question?
The lease term, and then are rents going down?
Okay, so what we've done really well is to try to prop up the face rates. I'm going to call it propping up. So the way this was done was give a tenant extra tenant improvement dollars, keep the rate higher, give extra free rent to keep the rates higher. Because by keeping the face rate going this way, you had a chance of like proving that there was growth in the market and like positive. And that's a trick of the trade. People are doing that for years, but now it's gotten pretty much out of bounds on this. And now, because of the inventory, and tenant reps now they're beating the crap out of landlords right now. They're going and going, listen, I can go to 15 different buildings and I can get all kinds of incentives. And by the way, your rate needs to start going this way. I'm starting to see some of this. We're experiencing it on retention and then RFPs from new tenants. So I think that is the one that's kind of like the last, hammer or whatever they're saying is to drop that is going to really impact where you see the turnover rents coming down. And that's going to take some time. So, one REIT here, public REIT is Highwoods Properties. If you look at their inventory, 96 properties, 75 of those properties, mostly suburban, were built, probably 15, 20 years ago. They're in the crosshairs. I'm not saying they're going to zero. I'm not saying that. I'm just saying they've gone from 51 down to 17. And I know they're in the market doing things. And it's a tough for some of these REITs because I'm starting to see, bet your point is that you're going to start seeing, I believe you're going to start seeing now the dip where rents are coming down. And CoStar's data is showing forecasts where 10, 15% drops in some markets of rates. And we haven't seen that for years because we've been really good at propping rates up that now we can't, it's going to collapse. There's too much pressure there, in my opinion.
Yeah, it's so refreshing and fascinating to hear you say propping rates up. Looking through some real estate investment data on offices, I haven't looked into that one. I will, but the rents had either stayed the same or gone up marginally, and then maybe vacancy went down a little bit, and that totally did not match the extreme bearish headlines in the Wall Street Journal or the Real Deal. And you're saying they're not bearish enough, which is also fascinating. You're saying it's kind of like, buy the $60,000 car and it's worth $60,000, but we're going to give you a huge deal. But in this case, we'll also give you a free engine, and we'll, in the office equivalent, basically we'll give you all these improvements and deals, but the face value of the rent is going to be the same. But is the face value marginally different from the straight line rent of how much rent you actually receive, or is the sort of propping up different from the rent you receive? It's the rent we're reving, the face value, we are receiving that rent. We're just also doing very generous things for our tenants as well.
So this is where this is good. We're slicing up the conversation here a bit from the entrepreneur kind of private equity space. Some of these things where you want to keep face rates growing, so you're going to prop it up and use these strategies. It's not unusual. It's not a mystery. You're giving a lot of free rent and like TI, but the net effective rent when you run it on a straight line back, it's going this way, right? The REITs now are about FFO, right? So it's cash flow. They're not going to try to get maybe the rates up as much. They're going to spend dollars where they can. But to me, if I was going to study REITs, I'd say, okay, let's talk about term and what's the transaction cost? Where are they going? And most leases have built-in escalators of 2.5, 3%. So you're going to see stuff go up. My point is market rents, I think now are going to start going down. So if the market rent, and that's really loaded too, because you have class A and you got all kinds of slices of class A, you get class B space and class C space. So you can cut and slice to make it look like the market's doing great and it's really not, and vice versa. It's all the stuff we talk about when you get under the hood. So my point is, if let's just say if you could, try to simplify it, you have class A office rates in a submarket of Nashville, and they were 28, or is 28 going to 26 or 25 in the next three years? I'd make an argument that there's plenty of submarkets going that direction. And I don't see structurally things change, because if you got, if and this is not unique to me, if you got a base case where you have 1 billion to 1.5 billion square feet that may be obsolete, I'm not sure what that drag looks like. And the cap rates, if they go more to a sustained level to higher because of the uncertainty, it takes years for some of these trends to play out, as you know. I mean, the mall stuff's been, and guys, you can make money. There's guys, I'm reading stuff in Wall Street Journal, but these guys are buying malls at 10 cents on the dollar, and they're trying to throw all kinds of, and they're selling out parcels. There's ways to, real estate allows you a lot of different levers to pull to make some money.
So rents are going down. You're pretty pessimistic. How does this impact your outlook on returns? And I should say, earlier when you said you think there's a lot of opportunity, on the one hand, that sounds like that might conflict with your realistic outlook, but it really is two sides of the same coin, right? Because if you think things are going to get really bad, if you're a well-capitalized player who can take advantage of things, like if you can buy stocks in March of 2009, you're going to do pretty well at the end of the day, right? So I guess what is your sort of your outlook on how this impacts returns now? Or is your entire office world, do you think values are much too high relative to what they're actually worth? And so, stated returns over the next few months or years, I don't know, are going to be negative, but then that'll be a great, fantastic opportunity to buy.
So this is the provocative conversation, right? Because tons of tension in all that, right? So you're trying to play this out on two sides. One is we have a portfolio. We believe it's materially lower than most of the BOVs and appraisals are coming in at, but it's not a great time to be selling. Like I wouldn't be selling right now unless it's forced, like a lender wants out, and we would try to restructure. And our investors, listen, our investors are pretty savvy, and most of them, they're being honest. I mean, we were probably 58% leveraged, 56 to 58% leveraged before the downturn, and we've got deals right now that the lender and the mezz are impaired, and some materially impaired. It's gotten that bad now. We're not class A office guys. We are kind of B guys taking it to B plus and doing some really cool creative office product. So those are going to take a little bit more of a hit because your rent roll and the tenant base. But that's kind of like middle America. That's where a lot of your companies come from. So there's that side to it. So we think if we can't work a deal with the lender and we like the asset, maybe we can. I made an offer on a deal recently. The debt was 24 million. I made a DPO offer at 9 million. The lender said, we get it. We actually think you're our best buyer. So it's a national bank. We don't know if we want to take the hit not yet or not, but let's take it to market to see what the market says, and maybe we'll give you a shot.
Wait, 24 million to 9 million. That was the value of the building, or that was the value of the loan?
That was the loan was 24 million, and the offer on the loan, which is basically we're saying the offer of the building, is worth 8 or 9 million bucks. Now we would that's a repurposing building to mixed use, SDRs, funky like cigar bourbon bar on the top. Open up because when you do this, you have now parking space. You have land available, and the parking you can reclaim. We do like boxcar retail, drop a brewery in, really kind of make it unique and different. Do some retail on the top, and do some what I'm calling co-working space 2.0, because we have WeWork experience, which that was a fascinating experience in itself. But let me go back to where I think the opportunity is, where we're spending, we call it really 4 pillars in office. We're doubling down in office in this context. We've got about 100 buildings in the Southeast we're tracking with very inefficient floor plates for office, but actually work well for either converting to hospitality or residential. So we take a tower and make it mixed use. We're not in the camp that for these guys converting to multifamily, 100% multifamily, you got to get the building to empty out. You got all these rents in there. You got these buildings that have 20% vacancy, and they have a tenant in there for another 3 years. And how do you get them out? And you got one at 50%, and you're not doing new leasing, but they're not empty buildings. So our model is more to look at repurposing floors and turn it to mixed use. Won't be easy. It's a lot of work. I think it could be tremendous opportunities, but you want high walk scores to distressed owners and lenders, and then really inefficient floor plans allows you to do really unique stuff for hospitality and residential. Because your problem, most of these buildings are going to be at least half to 50% residential. We like that model. We have creative single story office that's taking anything single story and kind of funk it out, like the old warehouse product, flex space. You could take an old retail space, you take an industrial space, drop, as I said, you just drop in enough amenities to make it unique. It's direct access, you don't have lobbies, you don't have elevators. So we like that. And then scraping buildings we talked about earlier, and then corporate campuses, we think that's unique. That feels like a pretty material upside, to, at least to guys like us. And then we're looking at being aggressive into third party management for receivers. We think a lot of properties are going back to banks. We think banks are completely overwhelmed.
Mhm.
I've tried to get the keys back, and the bank's like, I don't want it. I do not want it. Let's work a deal. The deal terms aren't great, Jack.
But aren't legally, if it's non-recourse debt, which may not be, I mean, that's an advantage of real estate investors who borrow against the bank. Like if I, borrow money to buy stocks and the stocks decline by more than the value of my loan, hopefully the broker will, do a margin call and get me out. But if they don't, like I owe the bank money. Whereas in the real estate business, correct me if I'm wrong, a lot of these deals are done on non-recourse debt. So if you borrow, if you buy a building for $100 million and you borrow $60 million and the value of the building goes to 40 million, so the equity is worth negative 20 million, you don't take that $20 million loss. You just say, hey, the bank, here are my keys, right? But you're saying in this case, the bank doesn't want to take the keys. Don't they have to?
Well, in this context, they don't want the keys back. They'd rather work a deal with you, and you have to. This is very, you got to be careful because the lender, doesn't have the staff or the team to probably take over a bunch of office properties, so they have to go to the sponsor. In my experience, a lot of sponsors are pretty sharky. They love to get the property back, so they work a relationship with the sponsor to manage the property. And that's not necessarily great either, because you got the guy who probably wants to buy the debt back at some point for cheap. And if people are being honest, that's in the cards. Not saying there's guardrails along those, but you just don't have a lot of. I feel like there's a dearth of like real, like the. I grew up at when they were like these guys were in the real estate business. They drank, slept, they operate real estate. I've also enjoyed the fact that we've been very creative with our financial structures. You got a lot of guys in the space that are not really real estate guys. They're just finance guys that
Mhm.
are arbitraging the space, and there's more than not. And just guys who know how to operate real estate. I think
Yeah.
it's not as many people around like they used to be. And people don't like to roll up their sleeves. It's a lot of hard work.
They're asset allocators. They're saying, I'm taking it out of my hedge fund sleeve and I'm putting it into the real estate sleeve. And they have a lot of quantitative models, probably have pretty nice suits, but they don't know how to talk to tenants. They don't know how the game actually works.
Yeah, it's the grind. It's the salt mines, right?
Yeah.
So I think there's opportunity there. So these lenders who don't want to back, they end up, that are non-recourse. Jack, you're right. A lot of these are non-recourse debt, but there's a lot of community banks and regional banks that double down, triple down in real estate in the last 2 or 3 years because some of the big boys weren't filling that gap and they jumped in. I think if you look at those, what do we have? 4,600 banks in the U.S. It's going to be very interesting with the FDIC and OCC and the Fed's doing right now and negotiating. They can't have any more SVB, Signature Bank. I mean, that was it. There's duration challenges, stuff like that. But there's a lot of small banks that are loaded up with real estate or having problems right now. And I'm negotiating with these lenders right now. I've got deals currently that I'm renegotiating. It's interesting what they're doing to try to get through this downturn. And I just think it's going to be fascinating. The opportunities. That's where I am bullish, Jack. I am very bullish about where it's going, but it's going to take time to get there.
I think you're absolutely right that the banks, their issues have been mark to market losses. Well, they haven't taken the losses, but the losses exist on their bond portfolios, and then depositors getting freaked out and there being a bank run. On paper, the commercial real estate, if you're a bank analyst and you're looking at commercial real estate loans, it actually looks good. But you're on the front lines. There's some losses on the front lines, but those losses have not been reported back to headquarters.
That's
So the
right.
official statistics that the general is looking at look good, but
Yes.
they're
So in
but
all that communication, so it's being real, and you got to ask the right questions to get to the truth, right? So back to your comment about product, right? Supply. Since 2020, there's 136 million brand new office space that's built in this country since 2020. That product, if built well, maybe it's got some ESG features to it, green features, clean air. So it's, maybe the newer stuff is cleaner. That should do relatively well. You're going to attract a tenant base. I want to be there. So what's fascinating to me is you got that. And then right now it's about, I don't know, anywhere from, it depends on the data source, between another, like currently going on, less than 50 million of new office space being built out of 5 billion. Well, if you have a flight to quality in this more creative product, and let's say you and I are sitting there going, okay, wait a sec, we've had about 4.5 billion of demand. Maybe that demand goes to 2.5 billion. I don't know where it ends up in the next 3 to 5 years, but let's say that that new demand, most of it wants something new, cool, and funky. And the supply side on that is only, maybe it's a 500 million square feet, but the demand's a billion or 1.5 billion. So there's a whole opportunity with the market shifts that's going to leave behind quite a bit of real estate. Yeah, Real Deal talks about it. Connect CRE talks about, all these groups talk about the groups that are kind of, this is like, the obsolete product that you got to know what you're shifting to. So that's where I'm bullish. This newer product seems to have the fundamentals where people want to go, because office is not going away. That's where people want to go. But all this other stuff that, what's that going to be? Well, I'm interested. I think that's really interesting, the story where they're going. I'm interested in what's left over, because I think that's stuff you can really, I think you'd have a lot of institutions bailing out on the cheap. You got to be back to rolling up your sleeves. You got to have the team to execute, to repurpose and restructure, or scrape or redevelop or mix use all this product over here. That, in my world, that's like a wealth creation that we haven't seen in a long time, because it's the destruction of a space going this way and leaving all this product behind that's just sitting in locations that could be, if you figure it out, crack that code. I don't know. That's where I think there's tremendous upside.
Hey everyone, we're about to get back in the action, but before we do, let me give you a lowdown on what's been brewing at Blockworks. Come March next year, in the heart of London, we're bringing together hundreds of the world's heavyweight asset managers. I'm talking about the big hitters, fund managers, allocators, payment providers, and the major high-frequency traders. They'll all be converging at Digital Asset Summit London, the mother of all digitally focused conferences in the institutional space. If you're curious about what the big money is up to in the digital asset scene, this is the event for you. We're diving deep into the intersection of macroeconomics and crypto, dissecting where we're at the market cycle, and we'll be getting into the nitty-gritty of real-world assets, so think stablecoins and on-chain treasuries. It's all in the mix. I'm going to be there, and so are the Forward Guide superstars. Michael Howell is going to be there. There's a rumor that Joseph Wang is going to be there. I don't know who started that rumor, but people are saying that. We're also getting into the minds of allocators, so you get a front row seat to what the big crypto money managers are cooking up these days. And because you're a dedicated Forward Guidance listener, here's an exclusive treat. Use code FG20 to get 20% off. Just hit that link at the end of this episode, so gear up, because I'm looking forward to seeing you in sunny London town come March. Thanks, let's get back to the interview. And so when you look at like the publicly traded REITs, do you think that the impairments have been fully realized, and if those prices? And I know it's different REITs, different properties, of course, but of course, private REITs, private investments, maybe they haven't taken those losses, and so their on paper returns still appear very good, but they have to take those losses. I mean, how do you think that's going to impact? Like, what do you think the next year is going to look like for private real estate investors?
So it's an interesting question, right? Because all these REITs have been beaten up. I think they had like a bounce here recently. Some of the office REITs, like 10 or 12%, but highways didn't, they're still at 17, I think. I mean, if they were at 51, most of those guys have 40% leverage, 35, 40% leverage. So I'm like, some of them, it's retail investing so interesting to me, because it can get way ahead of it and behind it. It's going to react differently than we're going to be slower in the private space, but I think we can kind of see where the value's going. But I don't know, Jack. It's an interesting question. I feel like a lot of them have beaten up. I haven't been following some of the bigger REITs that closely, Vornado and I guess, Boston Proper, some of those, but they're all, pretty beaten up. I mean, the question I have is, do you have a portfolio even at, that low leverage, that the rates just climb so high and you start losing so much erosion on your revenue and your yield, your dividends been cut. I mean, they got some room to restructure there. I just don't know how that, and it's so slow moving. Like,
Mhm.
people forget about you after a year or two and they figure a way to restructure stuff.
The real estate investment trusts, I have actually been fairly impressed in one aspect of their handling their interest expense. They really did hedge a lot of it out and, convert a lot of floating rate debt to fixed debt. So their interest expense is kind of capped, and they have muted the impact of the Fed's much higher interest rate expense. How do private investors in the real estate business handle that huge interest expense? I mean, is it a shock of, yeah, the 10-year went from 2% to 5%, and so the loan went from 4% to 7%. Is all of that realized, or is some of it more fixed rate debt, or is there also hedging in the private real estate space? Because again, as someone who's not in the industry, I can look at REITs and discover this, but the private industry, I kind of it's I don't know, it's very opaque.
Yes. So the short answer is yes, yes, yes. Long answer, it's complicated. There's a lot of, like, even I look at our portfolio, $750 million in debt when the rates start climbing. We've moved some of those properties since then. We had some of them hedged. We had rate caps in place, not long. Some were for a year, some were 2 years. Sometimes usually the duration of the first, first 3 years of the loan. Some of the smaller banks, we had no hedges in place, but we went from LIBOR to SOFR, and so it was priced off that, 150 bips on 30-day, 90-day LIBOR at the time. But some of those have gone up, Jack, 3x. And that's where we've gone to lenders who try to, like, I had one lender, I was at 9.5% at Community Bank, and I went to him, I said, listen, I'm looking for a 12-month forbearance so we can create cash flow. They didn't like that, but you got to make the hard ask.
Tough,
We
yeah.
ended up settling at 6% IO. They gave me a second on the property with additional dollars to cover the debt service for 18 months. And I can use the cash flow the way I need it. I'm like, oh, okay,
This is an
interesting.
amazing deal. So as interest rates went up, your loan went down in yield. You paid less. That's a good deal.
Yes, they were 9.5 and they were 6, and they said, we'll take 6. It's not great. But so I look at these banks that are getting pressures from depositors. They get, these, treasuries or whatever they bought, 2 or 3 years ago at, 1% yield or 0.5% yield. You got real estate. I don't know. You tell me. I mean, how's the banking industry going to play out in the next year or two, especially if you have a little bit of a lag, the rates stay higher yet. I don't know. What are your thoughts?
Well, I'm much more interested in your thoughts than my thoughts, but I think that banks are saying, okay, interest rates went up, and we're a little bit out of this phase because maybe interest rates are going to start going down. I mean, the Fed's Waller, Powell's trusted deputy, said that basically no more hikes. The pause will be extended until early 2024, and the market's now pricing, I think, exceptionally slim chances of more hikes, and very, very likely that cuts are on the way as early as next year. So I think we're out of the world of maybe 6 months ago of banks now thinking about net interest margins and the way that I want to talk about them. But as interest rates were rising, banks say, okay, these fixed assets, these fixed rate loans, why did I make these mortgage at 3%? That's going to be, the family is going to be there for 30 years. What did I doing? Why did I buy all these, mortgage-backed securities at fixed rates and treasuries? And on the mortgage industry, like people in the real estate industry, homeowners, they have the optionality. They can stay in the house as long as they want, which they will do as interest rates rise up. But if interest rates go down, they're going to prepay a ton. And so that banks are trying to short that optionality. So the fixed assets, we have tons of issues. But thank God we have our floating rate loans. As interest rates go up, we're going to be making more money. So our net interest margins will expand. They're not, they're shrinking. But okay, we have these floating rate assets to protect our net interest margins. And now here you are saying real estate developers who are borrowing the money are saying, actually, cut my interest rate or I'm going to give you the keys back. So yeah, it sounds like a problem.
Yeah. And depositors, on top of that, are getting higher yields. And I think the Fed is, I think FDIC, I think they're doing some really interesting stuff behind the scenes. They're either, orchestrating mergers, M&A stuff. I mean, they got to, because you get that stuff out in the headlines. Listen, there's so much psychology to what we're talking about. And if you get people in the sentiment going the wrong way or behaviors shifting on you rapidly, I think we've gotten so complicated as a business community and how we structure financing and all the derivatives. You got to keep your head on a swivel even more today with all the different variables. And it's gotten intriguing, but a little more. It's gotten complicated too.
So far, we talked mostly about office. You said you also have concerns about multifamily or apartment buildings. Tell me about that because there are people who say, yeah, oh yeah, office has got tons of problems, but multifamily is fine. Like for example, I know, well, whatever, the Blackstone Real Estate Investment Trust. I think they say we don't own a lot of office. Office is only a small, tiny fraction, but they own a lot of apartment buildings. They own a lot of other stuff. And so, is it the issues just located to commercial, just to office, or is it commercial real estate broadly and apartment buildings? Because I'll say a lot of the banks, they say, oh, office loans are only 15% of our commercial real estate loans, and they're not a huge part. So yeah, office is, only one part of the giant commercial real estate sector. What do you think of the overall sector, but particularly multifamily apartment buildings, which earlier in the conversation you said you had some concerns about?
Yeah, it's interesting, right? Because the sector's had an extraordinary run. Your newer product has done extremely well in the context of guys, probably, merchant guys, REITs have probably, certainly done well. I think that the deeper concern I have is like industrial multifamilies, but was priced for perfection. Like literally guys would go in there, buy a property, maybe it's a 3 yield, they fix it up, pump a bunch of money in, and then they think they're going to flip it out at a 4.5 yield. And I'm like, there's a lot of B and C apartments out there. There's a lot of aggressive folks going after that space, especially in the last 2 years. And if you look at it, just the debt, office is a slice, but multifamily is a bigger slice of the debt in the U.S. And I just, with costs, to run these properties gone up, I know we're more disinflation now, but, the inflation, the surge there, I think that, the debate's always been there's been more need for housing, but I think that you've got some operators in the space that were probably not as skilled and not as experienced. And their costs, there's been probably a number of cost overruns. And then they look at their interest rates, tripling or doubling if they don't have caps in place. And they're going, well, wait a sec, I was hoping to get out a 4.5 cap and now it's a 6 cap. I do the math on that because when you go from a a 9 cap to 10 cap is not as punitive going from a 3 to a 4. It's
Mm-hmm.
crazy. So that's when you price it for perfection and you have some glitches here and there, it flips it hard the other way. I
Yeah.
think that is people aren't talking about that much, in my space. I'm hearing more chatter, but I'm seeing data. Well, I can't remember. I thought I saw something that, distress office was leading, but, multifamily was catching up pretty materially.
Right. So fascinating you say that about going from 9 to 10, much less painful than 3 to 4. It's the exact same thing in the bond world. If you bought a 30-year bond yielding 10% and interest rates went to 11%, you're fine. I mean, you're getting 10%. I mean, that the yearly coupon of 10% maybe can even is more than that entire thing. So it's not a ton of risk. But going from buying bonds at negative rates and now yields go up to 4%, that hurts. So okay, so multifamily, it's tough because the official data, I mean, the most lagging of all in the inflation data, shelter that goes into CPI in terms of rents are no longer being raised at 20% as they were in 2021, right? And what are you seeing in the fundamentals of that space? And also, can you talk about the pipeline that's coming on? Because I know a lot of new multifamily has been built over the past few years.
It feels like some markets are getting hit with some softening. I mean, rents have been high for so long. I think your newer product will certainly do well. I'm laughing about it because we've had land with a lot of our office building that we call crotch land, like crotch space. Like it was always hey, we're going to sell you this asset, and he's got additional land. You can build the next tower, office tower. And no one ever did it, but we'd
Yeah.
always try to say the value. Well, it's interesting. I think we've sold 10 parcels in the last 3 years to multifamily developers
Hmm.
on, building right next to our office building. And it's been interesting to see. And I've talked to those guys quite a bit. I'm not as well versed on what's up to speed now, just what I've read and heard, but I'm not sure where rates are going to go on that. I've just heard more on the space that that a lot of money went into, were, when they were reading, pricing pressure, cap rates compression, that this older product had a great opportunity to do some facelifts. I think that areas I've heard has turned sideways. I just read a report from Arbor Realty. I think they're a debt group. And, I looked at all the multifamily they've done over the last 3 years, and I'm like reading stories. I'm like, it doesn't look good for some of that stuff. So I don't know the ultimate impact. I just know real estate is so interesting how it behaves. It's when I grew up into it, the first, S&L crisis was more the cause, back in the late 80s. Then you had the tech wreck, then the off, it's some part of the sector that's kind of dragging everybody down. It's the housing sector in the great financial crisis. Now it's office, but it has all this collateral damage, and apartments feel like they're close to it. Industrial, with Amazon pulling back, I heard the big, larger boxes may have some big challenges. The micro boxes, the last mile stuff should perform. And now I've heard like retail coming back, the strip center retail, which was out of favor for a number of years. So all these guys impact things differently, but multifamily to me intrigues me because I think there's a lot of money pumped in the space. And it's, like I said earlier, price perfection. And there's not much, it doesn't take much movement to flip that upside down.
Right. And tell me about experiential hospitality. Earlier, you said the office and the hospitality worlds are merging. When I hear hospitality, I think hotels, maybe Airbnb, but how do you define experiential hospitality and why are you excited about it?
So the trend we've seen more and more in office is how do you create an environment that gets people expect the office. For example, we're kicking around like putting in a climbing wall in the lobby. We got a generation, millennials, Gen Z, certain alphas coming up. That this is cool. That's funky. It's not like my dad's office, or and then you've got a micro brewery, tea, coffee shop there in the lobby that's really tricked out, intriguing. You have these provocative, really intriguing speakers that come in at 4:30, and then you have a concierge service that if you need anything done, we'll send it out and pick it up for you while you're at the office. Just there's a lot of discussion around that. The traditional office was, oh, have the cafe, have the work at the fitness facility, and then have a conference area. I mean, that's just like there's no zing to that. There's nothing compelling to it. There's nothing exciting to it. So
And would that also
whatever.
would that be called class A? We've talked about class A, B, C. Is it just a distinction of how many stories, how many square footage in the building, or is class A or class B? Is it a feeling?
It's more the art than the science.
Yeah.
Well, so one of probably the number one criteria is when it was built,
Okay.
frankly. So anything built new usually probably has a lot of the good stuff in it, and then it just kind of deteriorates over time.
What about like the
So
best building ever that was built in 1980? What would that be?
that would be likely a B, maybe close to a C.
Really?
But you can take some of these old buildings and funk them out and make them really unique, kind of cool. Maybe it's in a great location. You do something to the parking lot, activate the parking lot. When I think about hospitality in office, even the lounge here, like the lobby areas, they now have a fireplace in the lodge. They got the TV. It almost feels like a hotel lobby. You got fire pits out back. We've got some of that stuff. Just so like hotels have fire pits. In the evening. And I haven't seen one put a pool in yet for an office building, but it's just. I think we're in a now in a kind of a mindset where traditionally we put these things in kind of boxes and now they're colliding. And now to me, it's about, okay, Jack, what's our experience need to be? We have 24 hours. We're either in our home, we're in a coffee shop, we're in the office, we want to engage with people. I can now do work anywhere in the world. Technology is out. So it's really where you spend your time and how do you optimize revenue in that space. And that's
Mhm.
what I challenge and the opportunity that the real estate industry is going to go through on how do I optimize my revenue when that person's there? What are they paying for it or not? And Adam Neumann tried to do with co-working, WeWork, and there's some really interesting stuff there, but you could see where the train wreck was. But on the other side, it was probably brilliant. There's some stuff that he did really, really well.
When yeah, I thought of Adam Newman. So you're saying that there were some on the creating experiences and creating experiences and creating buildings that tenants will find value in and enjoy. He had a lot of ideas, but on the financial side, there were a lot of issues, and I think it's WeWork has gone bankrupt. Are they a model? We talked about weighted average lease terms. Let's see, they were entering into leases of very long term leases, so they were borrowing long and they were lending short to firms. And if the price of real estate goes down, square footage, that's not a good business model to be in. And by the way, they never made money. They I think they lost, billions and billions of dollars before of COVID and working from home became a thing. But yeah, what lessons do you learn from their fall? And you said you had a few experiences with them. I mean, they were a big player in the space.
Yes, and I think that you hit some important points about Adam Newman. He had some really, clever ideas, interesting ideas. It's all implementation of those are always the challenging part, and then making it profitable. So if we become a culture that's, values flexibility, office was a tough one, for many years because people wanted long-term leases. Well, he said, well, let's not do that. Let's go have flexibility, short terms. We'll make it really cool. We'll funk it out. Super engaging. It was exciting. It was good stuff. And would someone pay a premium for that? I do believe in that. I believe that, because you look at occupancy costs historically, 5, 7% of cost. For someone had the
Of a
right
total
culture,
firm's
right
revenue,
environment.
of a occupancy, what they pay for real estate in renting out an office, that's 5 to 7% of their total cost or their total
Expenses.
revenue.
Yeah,
Expense, yeah, yeah.
roughly on that. So to me, I'm like, well, if we're, HR is now leading the cause. We want people, employee engagement's important. You want productivity up. Why wouldn't you want to have an environment that allows that to be fostered and grow whatever, at a cost that you believe you're going to get it back on the other side? Well, the old days, like, here's your office, you got this, and the lighting wasn't great, the air was okay, the culture was like The Office, not really, but that was a great show. But it's just,
Yeah, yeah, yeah.
it's just different. So if you kind of break that mold and go, now you can have something like Adam was offering that's really unique, and you're going to pay a little bit of a premium, or maybe that's not a little premium. You go from 5% to 10%. If you can go from 5 or 7% to 10 to 15%, and you get what you want, and it's really cool, and you have flexibility. Maybe someone will pay 20% for that. So that's where it's an arbitrage, right? So if you can lock in long term at low rates, and you can go sell the product back in little pieces and get a premium for it, it's not that unusual model. I mean, people have done, figured it out. I mean, Airbnb, they're just renting it's other people's homes, and, people are, to me, it's just very intensive. You got to be very intentional. You got to have a program. You can't be zigzagging all over the place, and you have an offering that allows people an environment that they really feel they're going to thrive in, and then give them the flexibility. Like, Jack, we're going to downsize. I don't have to go through a painful restructuring with you. I'm just going to I don't need 7 offices. I need 5. Great. We'll
Mhm.
tear it up. We'll let you go take that. But guess what? You're paying you're probably paying double what you'd pay in an office deal if you had the whole place yourself and you sublet the space out. Well, I don't want that hassle. I want what I want.
Yeah, probably paying at a premium per square footage, maybe, but they're renting out a small amount of square footage, such a small amount that you couldn't get anywhere else. Like, I think I have worked at not WeWork, but a co-working space, and there were firms there that never would have really rented maybe, I mean, they would have rented the smallest possible unit. So it's having like 25 companies on a single floor, and they all are drinking tea together, and you're all working around. That's a good environment, and it can be a good business model. And it's interesting to hear you say some positive things about it. I think it was I've looked into it a little bit, don't know that much about it, but it was very heavily influenced by the venture capital boom, and it never really tried to make money. It just tried to grow as fast as possible. And I think the anecdote I remember is Mayoshi's son, founder of SoftBank, who invested in WeWork, was like, Adam, you lost $3 billion this year. Next year, can we make it four? Because they wanted to grow as quick as possible. And in real estate, it's about making money. And this concept of, I'm going to grow as fast as possible so I lose more money, maybe it doesn't make a lot of sense to the people who've been in the salt mines, such as yourself. But yeah, venture capital and real estate it's a strange mixture.
Yeah, I mean, Sam Zell made a comment, said something like, "Yeah, WeWork's biggest competition is Starbucks and an outlet."
Recently, I was in Midtown, and I have so many people were at this bar, and everyone was wearing their relatively formal business outfits. And I was just thinking, like, I think New York City, these office buildings, they're going to be just fine because people are going to work, and so many of those firms are in finance or law, where you want, if you're a lawyer and you're charging someone like a ridiculous amount per hour, you're going to want to take when they meet him, you're going to want to meet them in person. You're going to want to be wearing a nice outfit and shake their hand, look them in the eye, and take them to a nice office building. So I think like that part of the market, just my own uninformed speculation, might be fine in New York. I mean, in New York, and I'm biased because I'm in New York. Do you agree that sort of the class AAA, in New York will be fine. Again, I don't know about San Francisco. Say people in San Francisco, I mean, it's tech. They're not about meeting people in person. So maybe that's different. But I just feel like I don't know. I feel like in New York, maybe the headlines are too bearish, but in other parts, you're right that they're too not bearish enough.
There's conversation trophy to trash kind of conversation of what's really trash in the office sector, what's trophy, and that's getting redefined. So absolutely, the professional side, bringing the cities. There's going to be the question to my mind is going if you take New York or you take Boston or Philadelphia, Chicago, some of the biggest, LA. I've got a good friend out there in the office sector. There's going to be some part of the sector that absolutely demands that type of space. The question is how much do you really need there, and what does that look like? And their footprint probably is going to be less because they have a lot more flexibility in there. Okay, so I just go kind of macro how that's going to play out. So you and I sit around and go, maybe that's a billion square feet of demand in the US. Great. Let's go find that. And maybe it's undersupplied by half a billion right now, which is a unique opportunity. Maybe there shouldn't be 50 million of less square feet being built. There should be 300 million square feet being built right now. I think related property, some guys are taking that strategy. Let's just go build the nicest stuff out there. And we're going to try the outsized demand because there's nothing out like it. We're going to put all the bells and whistles on it. The other side to me is I'm like, well, you also, the GSA is a large user space in the US. Last data I saw is they're utilizing like 10% of that space.
Who's the GSA?
Yes. Yes.
Who is the
So,
GSA? Sorry, what does that say?
sorry, Government Services Administration. It's all the government leases. So I heard like DC is like a ghost town because no one's requiring these guys to go back to the office. So to me, it's real estate has become very, very, very niche. Like you've got the big four, you had office and you had retail and you had multifamily, like an industrial. That was kind of it, 20 years ago. Now it's so specialized. You got cold storage, you got data storage, you got AI. So I mean, so you got all these little slices, and even hospitality's got their slices. We see an office with their slice. So anyway, we're really gifted and talented at taking really complicated stuff and trying to bundle it into more generalist approach. And I get it why we do that. It's how we survive. But I think the conversation continues to go. You got to keep pulling this stuff apart and finding where the value is. And New York's a perfect. New York's a test case for office. Let's watch, see what happens. And I think Adam, I've talked to guys. A lot of our three lenders are in New York, and I ask them all the time, like, who's in the office, what's going on, and their policy. Where are they heading out? And I was up in New York 3 weeks ago and walked the streets. And I'm like, it's interesting. That's going to be a frontline area that's going to be very intriguing to see how it plays out. All the bigger cities, on that front.
And what do you think, to be as pessimistic as possible, what do you think is the city that has the biggest issues where it will just be a ghost town? I mean, you mentioned DC.
Well, I mean, San Francisco's kind of been in crosshairs. Seattle, it seems like some of the West Coast towns. LA's got their own challenges. The ones, the darlings, like Austin, Charlotte, Nashville, some of these darlings that people thought were immune, they're starting to have some issues. On downtown Raleigh here, these are smaller growth markets. Atlanta's had some areas, but now we've got the downtowns have been, I think, been hurt the most in a lot of areas, and even in the smaller cities. I'm just really interested to see how they're going to recycle this. I mean, New York always comes back, right? You're going to assume that. It'll be interesting to see what it comes back, how it impacts. Because office is a core for so many things. Restaurants, hotels. I've got some close peers in the hotel industry, and they said it's been really tough on downtown locations and some of these boutique, nicer hotel, or the business traveler. So all that stuff just takes time. So I'm so intrigued how it's tied to the financial side and all these lenders and where the REITs and how that's going to impact. And then where's the play? We want to make some money. So you got to figure that one out too.
Yeah. So you said it's not a good time to sell. I mean, what would have to happen for you to say now is a great time to deploy stuff? And I'm an aggressive buyer, going for the Hail Mary here.
For office, I wouldn't sell anything because there's nothing. Pricing's just got cream. But wow, that's an interesting question. It's like, I feel like to me, if I had to make a stab at something, it's if I could pick up properties and what I believe forward, like locations that are going to benefit from mixed use, stuff like that, and I can pick up, land value, I'd be buying that all day long.
Just buying land and then building on it later.
Yes, and reposition, and we're seeing that we're seeing that starting to happen. So guys who can create a fund that says, let's buy 100 office buildings at land value, and then we're gonna ride this out, and we believe it's worth X dollars over time. And they're in prime locations where you got so many open source, closed source data. There's so much information where things are trending toward. Outside of disruption, I get that. There's some things that outside of control, but there's enough data that gives you some insight. And AI is going to impact our space materially the next 2 to 3 years. It's been a quiet discussion AI, but there's going to be AI is going to probably make a lot better decisions than most humans do when it comes to investment decisions. But someone's got to go execute, right? So that's the messy part and the upside.
Your eyes wide open when it comes to work from home, remote work, hybrid work, which of course began for real because of COVID, because people were staying home to stay safe. I think it's fair to say we are not in that environment now. People who are working from home, they're not doing it because most people are, because they have a fear of getting sick. They're doing it because they can, and because the culture has shifted. And so you've been eyes wide open, and sort of your realistic attitude towards the lasting nature of that phenomenon, that everyone's not going to go back to work immediately, has served and will continue to serve you and your firm well. But longer term, do you really think that is I mean, are 20 years from now, 100 years from now, are people going to say, that global pandemic, that was a catalyst for people, the 5-day work week, where you go into the office and you take the train and you wear a business outfit, that marked the beginning of the end, and it was an abrupt end of that, and then the era of remote work or hybrid work began? Or do you think gradually those occupancy rates, maybe we're at 50%, and then 55%, 60%, where in 10 years we really are back to 2019? Like, what's your long-term view?
Yeah, I mean, I kind of look it back to human behavior. I think that one of the challenges, we've had what I call 7 head fakes. It became around, this is during COVID, around the holidays. It was like, oh, everybody's going to go back to work after Memorial Day. Oh, then it was Labor Day. Then it was after New Year's. Just never happened. And then people, when they adjust and get anchored in a lifestyle, and the perception is that the productivity is good enough, they understand the value of mentorship and people getting together. So there is a push there. So I've been a hybrid CEO for 15 years. So I've actually lived this, where I wasn't there in the office every day. I develop relationships every time. I meet people for coffee. I come in and talk to my team.
Mhm.
There's this quality of touch that is really, really important. If you do it well, it's less about infrequency and less about quantity. And I think that's where we're heading. And this physical space is almost irrelevant. It's where you decide to get people together at the right moment, come together as a team. Let's spend time. But I think you can do that. And I love my FaceTime and my personal time. I think you just want to put more value on it. And I think it's less about being back in the office. It's where the gathering spot is. What are you getting accomplished in here? What are you getting done? I think it's just a different mindset shifting. And I think that cat's out of the bag, that we're going that direction. We're going on 4 years now with this, technology's gotten better. So I think, and the value of the time together is really important. I think the intimacy of the relationship, the fierceness of the conversation, the upside of the conversation. I think, people, that tension's good in an office environment if it's done really, really well. So all that stuff coming together. And I think there's a lot of wasted time, 9 to 5, for 5 years. So, I mean, for 5-day weeks. So,
Mhm.
that I'm like, this is really interesting where it's heading. So 20 years from now, who knows what it looks like, but it's definitely a model that I feel that there's people, you're going to be driven people together for the right moments and the right time, and doing some really great enterprising thoughts. And then you're going to break out and do your thing. And there's autonomy in there, and there's performance metrics, and, accountability in there. And you don't have to do it being in front of everybody in physically in person. So anyway, that's where, so what does that look like? Who knows, Jack? I mean, I think there's a lot in there, but anyway, that's kind of what I believe.
Well, that's a really nuanced perspective, and it sounds pretty unbiased from a guy whose business is primarily in commercial real estate and offices. Because a lot of time you hear from people who office people who go on TV, and of course they're saying everyone's going to go back to 5 days a week. In the same way, if you interview the CEO of a copper mine, they're going to say, "Yeah, I think there's a shortage of copper." It's just like it's natural, and it's very interesting that you say you've been hybrid for some regards for 15 years. I wonder if that's because you're either working from home or because you're out in Florida, like hunting a deal or something. So what is the clearing price for office? Is office worth less? If Tuesday, Wednesday, Thursday, people are having this great experience in the office, but they're not there Monday and Friday. If it was $20 a square foot, is it 40% less? Is it what? That's $12 a square foot because of Monday. Minus four for Monday, minus $4 for Friday.
There's a need for real estate because every day you wake up, when we're alive on this earth, we are occupying some kind of real estate. Back to your question, like what is office worth today? If you're companies may hold on to the old thing, like we want to keep this much space, but we got people only on Tuesday, Wednesday, and Thursday, so we don't need it the other days. Is there other ways to utilize that space, or is it a different model, or are there different features to it? I don't know. That's all good part of discovery as we go through this kind of, this shift. I just know that, whatever was in 2019 of office is now so broken that to value office today is a little bit like you're rolling the dice, and it's not that extreme, right? But there's still enough in there going, you know, there's a big debate, I think it was in New York, all the discussion about amenities. There was a big debate, like, is you're just throwing good, we're amenitizing buildings, you're wasting, that's not really what they want. And, it's oversold and this, that, and the other, because that's a lot of money to put that to attract tenants back. And then you go back into human nature and culture. We want to get together, but, you know, most people engagement, but HBR, Harvard Business Review had a great article on passion. What does passion really need? I want to be passionate, love what I do. They said this threshold about 20%. If you had 20%, like you love what you do, if it falls below that, engagement drops off materially. If it goes above it, it becomes self-serving. Like I want more, I want more passion. And the way I look at it is the harder you work, the more difficult it is. You learn to appreciate the other things more, but there's got to be a right balance there. And companies have been, probably done a really poor job with their employees. Where do you stand? Where's your growth? Here's the mentorship. It's kind of like, it's been not really, inspiring. So I don't know. There's a lot of stuff in there that is just really intriguing to me. And real estate just happens to be a part that touches people every day of their life. And there's, if you can find a way to reposition going forward, there's an opportunity there. And that's what I think really intrigues me, at least my competitive side, making money and with investors. And, we got private equity groups, stuff like that. I think it's just an intriguing time. And it's an inflection point in real estate.
It is an inflection point, and they're definitely. I mean, if you're passionate about your work, you're going to be you're going to be a shark whether you're working at the office or you're going to be a shark when you're working at home. If someone's not passionate, they may they're not going to be a shark at work, and they're not going to be a shark at home. But it's easier. It's a lot easier to you have to go through the motions in the office. You have to show up. Whereas when you're working from home, you can just move your mask pad around. It's a lot harder for employers to track employees. Do you think that will be like drawing people back to the office? And I also think that firms who want to stop hiring or even reduce headcount, layoffs can be really bad for morale. If you say everyone has to be in the office 5 days a week, some people may leave the firm, and there's cost savings, and then also I'm speaking from a strategic point, the people who stay may be a little bit more motivated. So do you think that will be a catalyst for back in the office? Even though I know people have been saying this for 3 years and it hasn't happened really, but
well, I think yes. I mean, there's a cleansing going on. Getting back to the office, here's my thing. There's a percentage of companies that do it really, really, really well. They have a culture. It's very intentional. People understand it. It's hugely engaging. It's very fulfilling. I mean, if they're being honest, they're like, it has nothing to do with 9 to 5. I'll be there like all day and on the weekends. It's just, what are you driving? What's the product? But I'm just saying, to me, that needs to be bigger slice. And then the question is, where is that getting done? Traditionally, we've called that the office, but that's been a small slice of the culture of our business. I mean, most of the stuff you read and discuss are, people, it's become almost transactional. The loyalty is not there. They don't feel they're getting good direction from leadership, and that's age old. Not everybody's going to do it, but I think I've heard that less than 10% of the corporations really have a culture that people are inspired and fulfilled by, and it's hard to do, Jack. It's a lot of work.
But you're also right that people saying, "Oh my God, there's no culture of loyalty and there's no great corporate culture, unlike in the good old days." I'm like, when was people, everyone, 100% people love going to work?
And I don't know who said, culture eats strategy for lunch, I mean, that stuff, it does, but I'm with you. Like, we've got a long way. And, considering 100 years ago, how people used to work, it was like a privilege, you're the boss, you do whatever they said. Now we've waken up. And I think that's good. I like that pressure. You
Yeah,
want,
yeah.
I love people that know how to manage up. Like, I challenge my people all the time. Like, I ask myself, am I rational? Do I think, can you influence me? And if you tell me all this stuff, am I pragmatic? And they say yes. And I said, you better manage up well, because by you managing up well, we're going to do great things together, because it can't come from leadership every time, but you got to have that culture built that way. And people got to feel valued, and they got to feel like there's some risk there, and there's some opportunity and stuff like that. But you got to spend a lot of time on those things. And I can tell you right now, beginning my career in business, I did not do that well. And I learned a lot of hard lessons, and I see the value in it. But the technology has now added a whole new element to it. So back to my point, I think it's not going back to 2019 in office. It's not going to be everybody's remote. It's somewhere in the middle. But when you're in the middle, what that looks like is going to be very interesting, and it better be super engaging in the culture, right? And I think you can do some great things. And Jack, if you're super efficient and you're really good and you love what you're doing, you could do it in less time. You're like a machine, and you need your personal time and development time. There's all that stuff in there, but striking that balance is really important.
Right. And my final question is, what do you think, if there is kind of a meltdown in commercial real estate or office, or if there already is a meltdown and it's just not being seen, what do you think the impacts of that are on the broader economy? Because, obviously there's the subprime mortgage crisis, not saying, this is anywhere going to be close to that, but, a lot of those loans were owned by banks in very complex financial products, owned by banks that were extremely integral to the main economy. And so there was like structural damage to loan creation, that lasted, in some cases over a decade. How how important, real estate is a huge industry. Office, you said 20 trillion. I don't know, you said, but I mean, can people kind of take their lumps and the economy won't really change? Or, on the spectrum of people take their lumps, it won't really change, to it's systemic. Where do you think this falls?
It's an important question. It's an interesting question. It's a provocative question. So let's, so, office is, I mentioned about 20 trillion. So I think I heard something like 300 trillion worth of real estate. In real estate, there's so much mystery behind it. To me, there's this confidence issue. There's the psychology issue. It gets out that more banks are failing. Basically, where does that bleed to? How fragile we, as when it comes to our financial system right now. So it's all this stuff that kind of accumulates in my mind. I just feel like we're just very skilled at keeping things as positive as we can, knowing that sometimes these things work themselves out, which I'm in that camp too. There's a lot of work around, and we've got some levers. Now the Fed's giving it some room by the rates, but that's a pretty blunt instrument. Start lowering rates. What does that mean? I just feel like, I was very disappointed during the great financial crisis. I thought there was going to be a lot more fallout in the real estate space, but then the Fed came in. There was, whatever you want to call bailout. There was more money pumped in the system. It never really happened. I was kind of hoping that I'd get a chance to experience the S&L crisis, the fallout on that. Tech wreck wasn't that bad. This one feels different to me in the context that, if the Fed stays where they're at and they're willing to see a strong correction, and maybe we got to, maybe there is too much wealth in this system that the Fed has basically created for this country, and maybe private equity. I've heard interesting debates about how the Fed feels, or Powell feels about private equity benefiting. That there's a more of a major correction, but the lever is, are they going to capitulate and start drastically lower rates? Are they going to throw money back in the system? I'm very skeptical right now. I was probably the camp a year ago about the Fed maybe pivoting or putting money in the system, because that seems to have been the bailout. As much how painful it could be, if we can stay rates longer, I'm in your camp. I feel like the rates, could come down next year. Maybe they stay up here longer. But I just think that all these folks that were on, this low interest rate, I don't know how much was floating out there, but all that lags, and that just I'm seeing the cracks were forming 6 to 12 months ago, but it's slow. Next year, I think I'm going to see, if we stay at the rates we are now, and even if we go back 50 bips, 100 bips in my space, I see some major material. Either banks are going to get a bunch of properties back, or they're going to be taking much lower rates and they're going to feel more pain. So I don't know, Jack. It just feels like there's going to be some material pain in there somewhere, but not unique to real estate. But real estate is going to be a big part of it. But a lot of guys are floating. We're floating. I think the lag effect could be a big impact.
A lot of guys are floating interest rate debt that's more expensive as interest rates go up. So you said that in the great financial crisis, you thought there would be more pain in the real estate world. I think what you meant is your world, the commercial real estate industry, maybe office. Obviously, the eye of the storm was subprime mortgages, primarily owned by families and individuals, so not commercial real estate. So do you think that you thought it'd be worse than it actually was? That's interesting. I mean, do you think this could be worse than the commercial real estate in 2008? Not worse than subprime in 2008, but worse than commercial real estate in 2008, which you said you thought it would be worse, and it wasn't actually that bad because the Fed lowered rates. Yeah.
I do. I mean, unless we go to easing and we pump a lot of money in the system, then if we stay in rates at 4.5%, 5%, we don't pump a bunch of money in the system, and QT is a little tricky to me. I don't know really what there's a lot of stuff behind the scenes they're doing that I think I'm not really sure what the balance sheet looks like, but I'm like, yeah, and I think that's we probably need a good jolt here to get put a better foundation. I think we've been bailing ourselves out for 15 years, and now's a chance to get there. And I'm not a big fan of MMT. I think I'm not a fan of all of that and leading to socialism. It's not helpful for the private sector. And we had 17 trillion of negative interest rate bonds. What's happened to all that stuff? That was interesting discussion, 2-3 years ago. So if we stay at 4.5%, 5% floating rate, there's a correction, bigger corrections out there. Now, what's happened behind the scenes? There's a lot of powerful people doing some things that who knows the hell they're doing to make it not as worse.
Wait, what do you mean? What's the last part you said?
Oh, just like behind the scenes, like if I think about like the banking industry, when I'm talking to these lenders, is the FDIC and, OCC, what are they doing so we don't see a bunch of banks failing next year or 2 years? Are these smaller banks? If it comes out, I think at SVB and Signature and First Republic, I'm like, okay, that was over there, but I don't know. I'm talking to these lenders, and I mean, they're behaving interesting. That I don't know. I'm not saying there's like this dark mystery in it. I'm just saying there's a lot of tools out there to make it, to blunt this or mute it. I like your word, so it's not as bad. We're good at that.
Yeah, and so last question, I promise. But so the banks, do you think that private credit and non-bank financial lenders are going to take a large share as banks pull back or decrease their rate of lending?
Oh, it's interesting. Well, they did, for a while. The private debt funds came in, jumped in. I'd say yes. I mean, we're talking to a handful right now on buying debt back, and it's 750 to 950 over SOFR. And it's very punitive, but it's in a first lien position. So yeah, they're sitting on a lot of money, and they're seeing a ton of deals. What the guys I'm talking to, they just said, there's still enough uncertainty, at least in our space. Some of the spaces they probably like better, I get it, but there's still just enough out there that, they're still being it appears they're being cautious, but they're still, Preqin, which is stuff they measure a lot of the private equity space. There's 400 or 500 billion, the dry gunpowder in the real estate space sitting on the sidelines. So it's just a lot of money out there still,
Yes. And although some of that dry powder is money that their clients have agreed to give them, but haven't given them the money yet. So the powder's there. They don't have the power. They have to call their clients to give them the powder.
That's right. And that's a whole different, yes, we have some of those relationships. Those can get tricky too.
Yeah. Well, Anthony, thank you so much for coming on. This has been a true joy to hear your insights. You have a perspective for someone who, studies the real estate industry or is an analyst at a big firm, that their analysis is really valuable, but it's also, it's so different to hear someone who, is actually doing deals and really, on the front lines of this, and very interesting to hear that you think there are a lot of challenges, to put it lightly. And, I thank you so much for being generous with your time, and thanks everyone for watching.
Welcome. Thank you, Jack. Really enjoyed it. Take care.
Forward Guidance, the program you just enjoyed, hopefully, can be viewed on YouTube at Blockworks Macro or heard as a podcast on Apple Podcast and Spotify. Episodes are typically released on Apple and Spotify a few hours before they air on YouTube. Please leave a review on Apple Podcast if you feel so inclined.